Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market concentration, jobs data, and tech shifts. This video presents a direct informational narration of the source document.
So here's our roadmap for today. We're going to start with a macro overview of the latest jobs data. Then we'll look at a really surprising preliminary agreement between Apple and Intel. From there, we'll examine the liquidity draining the semiconductor market, compare today's environment to historical market concentrations, and wrap it all up with a quick valuation check. Let's get right into it.
Section 1, Macro Overview and Jobs Data.
Taking a look at the broader macro picture, major indices recently saw some solid gains. We watched the S&P 500 and the Nasdaq recover prior losses, and this was driven almost entirely by the tech sector, which jumped over 3%. Now, with cyclical and energy stocks kind of pending clarity, mostly due to geopolitical factors and high oil prices, all eyes have shifted right back to employment. And turning to the non-farm payroll data, well, the numbers show a really resilient environment. April added 115,000 new jobs. That easily beat the expected 62,000, and it comes right alongside an adjusted March figure of 178,000.
Breaking that data down a bit further, sectors like healthcare, transportation and warehousing, and retail trade all saw job growth, while government employment actually continued to decline. The unemployment rate itself held steady at 4.3%, which lined up exactly with expectations. We also saw the labor participation rate take just a minor dip, going from 61.9% down to 61.8%. Now, looking at wages, the month-over-month growth for April came in at 0.2%. That's slightly below the projected 0.3% and matches the rate we saw in March. But year-over-year wage growth actually accelerated from 3.5% up to 3.6%. So what's the big takeaway here? Because unemployment hasn't spiked and payroll additions look optimistic, this robust data keeps the Federal Reserve's primary focus firmly on managing inflation.
Moving right along to Section 2, Apple and Intel partnership.
Shifting gears to some specific corporate developments, recent stock action has been pretty notable. Intel actually surged 13%, supported by some highly active options trading. And a central catalyst for this? Well, it's a Wall Street Journal report indicating that Intel has reached a preliminary agreement to manufacture chips for Apple. This perfectly illustrates a massive strategic reversal. Think about it. Just 6 years ago, Apple famously split from Intel to build its own silicon in-house. But today, facing external pressures, Apple's officially re-engaging with them. This whole development is actually situated within a much broader government-driven push. Over the past year, Commerce Department Secretary Litnick held direct meetings with major tech executives. We're talking Apple's Tim Cook, SpaceX's Elon Musk, and NVIDIA's Jensen Huang, basically urging them to conduct business with Intel. And facilitated by government investment initiatives, Intel has now signed letters of intent with all three of those companies. But there's a really crucial point to keep in mind here. These are strictly letters of intent right now. They absolutely lack finalized production commitments. So the market is currently trading purely on the expectation of this news during a highly speculative phase.
All right, on to Section 3, the semiconductor market squeeze.
This concentrated capital flowing into select tech names is fundamentally altering broader market mechanics. As semiconductor stocks rallied, underallocated institutional investors were essentially forced to chase the momentum. This forms a mechanical feedback loop. Stock prices go up, volatility drops, and call option demand just keeps increasing. The end result is a massive liquidity drain. Capital is being aggressively pulled into tech, healthcare, and consumer goods, while the remaining 8 S&P sectors are exhibiting extreme volume contraction.
And this liquidity drain results in a severely top-heavy market structure. Let me put that into perspective. While the Nasdaq 100 index rose by 2.3%, only 52 of its 100 constituent stocks actually advanced. That means the index's growth is heavily reliant on a select few semiconductor stocks. We're seeing a very similar dynamic over in the S&P 500, which grew by 0.8%, even though only 209 constituent stocks advanced, compared to a whopping 294 declining. This disproportionate weighting is being driven by strong fundamental earnings and AI capital expenditures within the semiconductor industry, and that, in turn, forces passive index funds to continuously purchase these specific equities as their market caps expand. Which brings us to Section 4, Historical Market Concentration. While the fundamental drivers for tech are definitely present, this excessive concentration leaves very little margin for error if leading equities happen to pull back. Driven by the AI wave, specific market caps have absolutely exploded.
We've got Micron exceeding $800 billion and Broadcom reaching $2.4 trillion. Staggeringly, the combined market cap of just the top 10 AI-related stocks now accounts for an extreme 41% weight of the entire S&P 500 index. It's wild to think about.
To contextualize that 41% concentration, if we look at historical data since the 1960s, it shows three comparable peaks. First, you have the Nifty 50 dominance back in the 1970s. Second, the Japanese stock market in the 1980s, which peaked at a 40% weight in the global MSCI and ACWI indices. And third, the year 2000 dot-com era, where tech and telecom reached a 41% peak weight in the S&P 500. Now, historical records indicate that all three of these prior concentration peaks were subsequently followed by massive declines in the respective market cap weights. While this definitely highlights statistical risk, it doesn't necessarily mandate an immediate market correction today.
Let's look at Section 5, Valuation Check. To objectively assess whether today actually mirrors the year 2000, we need to look at forward valuations specifically within the semiconductor sector itself. Following Q1 earnings, there have been some substantial upward revisions. Taking the Philadelphia Semiconductor Index as a whole, the forward PE ratio is currently sitting around 24x. By comparison, during the absolute peak of the dot-com bubble, that forward PE ratio reached somewhere between 30x and 32x. Therefore, looking at it from a strict forward-looking perspective, the current market has not yet reached those extreme year 2000 bubble multiples. Beyond that forced passive buying we mentioned earlier, individual stock success right now is heavily dictated by tangible AI revenue. Companies that can explicitly prove AI-driven growth in their actual earnings are being rewarded. For instance, Datadog rallied 31% and Fortinet rose 20% after they explicitly highlighted their AI drivers. On the flip side, companies lacking this fundamental proof are facing lagging prices or even potential new lows. So, the market is currently locked in a persistent mechanical feedback loop of rising prices, falling volatility, and forced buying. As long as liquidity and real earnings support this, the trend can absolutely continue. But as we've seen, history shows us that extreme weight concentrations eventually have to resolve. So the ultimate question we are left with is this. Will this high market concentration sustainably drive long-term growth anchored by real AI earnings, or will it ultimately create future volatility as the index is forced to normalize?